Yes, hello friends. This video is on the topic of types of loan repayments. So what are the types of loan repayments? What I mean by types of loan repayments mean what is the composition of that particular repayment or installment that you are making to the bank if you have taken a loan, or suppose if you are modeling the cash flow as a person from a risk management department of a bank. So this lecture is helpful to you also. So whatever is the cash flow, what is the component of that installment? What component is principal and what component is interest? So we will start by looking at the various calculations, the various types of loan repayments. Okay, so the first type of loan repayments that we are going to discuss is the equal principal. Many loans are given in such a way that every installment has an equal component of principal. So what do I mean by it? So once we take an example, you will understand. Equal principal means every loan installment that a client or a customer is paying back to the bank, or the inflow that the bank is having on each and every installment, the amount of principal that is recovered is equal. Okay, so we will model it. Now, suppose we are talking about a loan that is of amount 100,000 and the interest is suppose 12%. Now, this interest is yearly interest. Suppose if we want to find out what is the monthly interest, what we can do is we can divide this by 12. This will be monthly interest. And suppose the tenure of this loan is 1 year. The tenure is 1 year. And what is the tenure in months? The tenure in month is 12 months. Okay, so now we are modeling this equal principal kind of loan repayment. Okay, so and this loan has to be paid back in 12 months in 12 installments. So how we are going to model it? So first we will start with the month. So 1, 2, 3, 4. So the loan has to be paid back in 12 months and the loan payment is at the end of that particular month. This is the column for opening principal, means before the loan repayment, or we can say at the start of the month, what is the outstanding principal. So here we can take this 100,000. We will fix this. Okay, and what is the installment that we are paying? What is the installment that is being paid to the bank? What is the total cash flow that the bank is having? Out of that installment, what is the interest component? And what is the principal component? And finally, what is the closing principal after you have paid this particular installment for this particular month? So here you need to realize that the principal component that is see, this installment will be sum of this and this cells. It will be sum of interest component, principal component. So you need to understand that equal part of principal is being recovered in each and every installment. So we have to first find out what is the principal component. So this will be 100,000 divided by 12. Okay, and so for every installment, this component is going to be the same. Okay, and similarly, since this is a same, we can also find out what is the closing principal, that is opening principal minus the principal that has been paid in this specific installment at the end of the month. So closing principal at the end of the month is this much. Okay, so now what is the interest component that is being paid in this first installment? So the interest component will be the opening principal at the start of the month multiplied by the monthly interest rate. Okay, so this is the interest component, and to find out the installment we will have to sum this interest component plus this principal component. Okay, now what is the opening principal for the second month? It will be the closing principal for the first month. Okay, and what is the interest component? Again, interest component will be the interest that will be paid on the principal that is outstanding at the start of the month. So that will be 1% into the 91667. So it will be 1%. So it will be, just a minute, I will have to fix this 1%. Okay, this I have fixed. Just a minute, I will convert all of them into two digits. Okay, and the closing principal will be the opening principal minus the principal that has been paid in this particular installment, and the installment will be the sum of interest component plus the principal component. Now what we can do is that we can drag all of them down. We will see what happens. Okay, so now we have, this is the entire repayment schedule that we have made. This is the entire repayment schedule for equal principal. So what is happening is that, carefully see that the principal component is remaining same. The interest component is reducing every month. Why it is reducing? Because the outstanding principal at the start of the month is reducing, and principal component is constant, interest component is reducing, so installment is also reducing every month. So this does happen. So I have personally observed in case of several agricultural loans or loans taken in rural parts of India, or agriculture is taking loan for purchasing tractor or those all things. The kind of repayment is similar to this. The only thing is that that is a yearly payment instead of being a monthly repayment. Fine. So this was equal principal. So in every installment, this is the crucial amount. This is the amount that the bank is getting. This is the amount that the bank is getting every month at the end of every month. in this particular installment, the principal component is this, and this principal component remain constant for all the months. The interest component keeps on reducing because you can see the principal outstanding keeps on reducing. Now, the second kind of loan repayment that we are going to discuss is the equal monthly installment. The equal monthly installment. So what we are going to do is that we are going to take a similar example, means a loan that is having similar parameters, like the principal being 100,000, the yearly interest 12, so monthly interest being 1%, tenure being 1 year, or in month terms it is 12. So now again, similarly, the month nomenclature will remain same, 1 till 12 month. So the repayment is going to happen in 12 months. Now here the important thing about equal monthly installment is that the installment is going to remain constant throughout the 12 months. The installment is going to remain constant. Only the interest component, principal component are going to vary. So we can calculate the installment immediately. So the installment, we use the PMT formula in Excel. So here what is the rate? It's 1% because it's the monthly interest, and the repayment is going to happen every month. Again, fix them. Fixing is important. Number of repayments are how many? 12. So we'll fix this also. And the loan that is being repaid is how much? 100,000. And we have taken this minus sign because it's outflow for a bank. The installment will be inflow for the bank. Just a minute. So this is the installment. This is the installment for the loan. Okay. We will remove the currency sign. Just a minute, guys. So this is the installment we have calculated. So you can see the installment is same, but what is happening with principal and what is happening with the with interest, that we will find out. Okay. Now I will just copy this amount here. It's 100,000, the opening principal. Okay. Opening principal. What is the interest component? So what you have to do is just take the opening principal and multiply it with the monthly interest. So that is what interest that you are going to pay at the end of the month on the principal that is outstanding at the start of the month. Okay. What is the principal component? Just take the installment and subtract the interest component. You will get the principal component. What is the closing principal? Take the opening principal and subtract the principal component that has been paid in this EMI, equal monthly installment. Okay. Now opening principal here will be this. Okay. Interest component again. Just a minute. Will be this. Just a minute. So this will be, I have not fixed it. Just a minute. P3. So now I will drag all these formula down up to 12 months. Now you can see that the closing principal at the end is becoming 0. So here you need to understand that the installment is constant. Okay. You can see that the interest component is reducing, and you can see the principal component of the installment is increasing. So this is the nature of EMI that you need to understand. So see, so you can always calculate EMI. If there is a quarterly payment, you can calculate EQY. If there is a half yearly payment, you can calculate EHI. If there is a yearly payment, then you can calculate EYI. So it will depend. So the interest, then interest you will take will be monthly here, quarterly here, half yearly here, yearly here. So the interest will vary, and the payment also varies. So here there will be 12 payments per year. Here will be 4 payments per year. Here the payments will be 2 payments per year, and here the repayments will be 1 repayment per year. So this is what is, and see, and again this repayments that we have calculate assume that we are assuming that the interest rate are going to remain constant, or we are assuming this is a fixed rate loan. Similar was also the assumption when we are talking about equal principal. So if we try to address the variable interest rate issue, then that is an entirely a different animal. That is a completely different animal, in the sense it's very much similar, but now at repayment of every installment we will have to worry what is the interest rate applicable. Okay, so that is that we will take in some other lecture some other time. Now we will focus on the next kind of loan repayment. So we have talked about the equal principal, we have talked about the equal monthly installment. Now we are going to talk about a very interesting thing, an interesting kind of a loan repayment method known as rule of 78. Rule of 78. So again what we will do is that we will take the same components, we will take the same parameters. Okay, we will take the same parameters. Now in the rule of 78 you need to understand one thing, that the bank by itself only decides the interest in amount terms. Okay, they decide the interest in amount terms. So this I have taken from the EMI sheet, my last sheet, but they would have already decided what will be the interest amount, total interest amount that they have to recover from you. They will also would have already decided what is the installment amount. Okay, so here you cannot say that I have calculated the EMI, this is this much, why you are charging me extra or something on the higher side. Okay, so here they would have already decided what amount of interest they have to recover from you, as well as what is the installment. So again what we are going to do is that we are going to take the interest amount from this example. So what we will do is that we will take this example. We will find out what was the total amount of interest, 66185. So suppose we take the interest at 6619 that the bank has to recover across the 12 repayments, plus the installment. Again we will again take it from here only. We will take installment, suppose 8885. 8885 is suppose the installment. Okay, now what do you mean by the rule of 78? So the rule of 78 means The rule of 78 means that when you sum these months, how much it will come? It will come to 78. So in the first month, how much of interest is going to be recovered out of the total interest? The amount of interest that will be recovered is 12 divided by 78 of 6619. Okay, so this will be, this much interest is going to be recovered in first month. In second month, how much interest is going to be recovered? So it will be 11 divided by 78. Next will be 10 divided by 78. Okay, so what I will do is I will write this in reverse order. Just a minute. Okay, and now I will find out what will be the interest component. It will be 12 divided by the 78. So I will fix this. I will drag this down. So this interest component, I will also convert this into percentage. So around 15.38% of interest that I have decided to recover. Now you can forget this interest rate, okay, because bank has decided what it is going to charge you. So I took it just to make the calculation, or understanding it easy. They will directly tell you this amount, and then they're going to recover this percentage of this amount, then this percentage of this amount. Okay, so we will directly first calculate what is the interest component out of this total they are going to recover. So this will be this. I will fix it. Into this. Okay, so this is the interest component. Again, you can see similar to EMI, the interest amount is reducing. What is the EMI that we have agreed upon? This is the EMI. Again, I will fix it. Again, here also EMI, instead of writing it as instead of calling it as EMI, it's an installment. Okay, EMI is for EMI concept. For rule of 78, we will again use the general term installment. So this is the installment. Okay. Now we will calculate the principal. This will be installment minus the interest component. This is the principal. Okay. Now we will take the opening principal. The closing principal will be the opening principal minus the principal component that has been recovered in this particular installment. I will drag them all down. See, we will see what happens. That it may not be accurate. There can be some issues. Just a minute, huh? Just a minute. I hope that it goes down to 0. So it went down to 1. Just a minute. Okay, so the closing principal is what it is telling, -1. It means it is recovering, and 1 extra it is recovering. So what we can do is that, can we reduce the installment, no, by the interest amount by 1? We will try what happens. We will see. Oh, it increased. So we will increase it by 1 then. Okay, now it is getting. So we have decided. So what happened is that we use the EMI concept to understand this, to arrive at the figure, this interest component. Otherwise the bank will tell you how much interest it wants to recover, and then it will use this formula to calculate the interest component, principal component of the installment that has been agreed upon. So it is somewhat similar to the EMI. When we see the cash flows, they are similar to uh, EMI, because we can see the installment is remaining constant. The loan repayment that the bank is getting or the client is paying is remaining constant. The interest component is reducing while the principal component of the installment is increasing. Okay. So I hope that you understood this. So this rule of 78, you need to understand that it is just not, it is not only applicable to a 1 month, a 1 year loan, but it can also be applicable to a 2 year loan. So in case of 2 years, what will happen? The denominator for calculation of interest rate percentage will be equal to how much? It will be, suppose in case of, so for example, in case of 1 year, how much it was? It was equal to 12 into 12 plus 1 divided by 2. So 78. For 2 year, how much it will be? For 2 year, it will be um, 24 multiplied by 24 plus 1 divided by 2, 300. So it becomes kind of a rule of 300 in that case. So it is possible for longer term loans also, but to explain, people generally start with this 12 months loan, where the denominator for calculation of interest rate percentage is 78. Okay, so hope I have helped you understand these all issue, these three kind of loan repayments. Equal principal, where the principal component of the installment remains same for all installment, though the installment amount will keep on changing. But for EMI and rule of 78, the installment remains constant for every repayment. The interest amount, it keeps on getting reduced. The principal component, it keeps on getting increased. So thanks for attending or looking, thanks for viewing this video. Thanks a lot.